Hello, Gold Silver family. Alan Hibbert here with another video. And today I want to go through some of the comments that Jerome Powell made in Jackson Hole last week. And I want to look at what the Federal Reserve has been doing with interest rates and how it's been affecting the CPI and unemployment. That's their dual mandate. So first, let's start with an article from Zero Hedge. The Powell pivot is complete. Gold, stocks, Bitcoin, and bonds surge as Fed chair says time has come for policy to adjust. So Jerome Powell did say that there are going to be rate cuts coming soon, but he did not say how big they're going to be or how soon they're going to come. The markets are expecting those rate cuts to start as early as next month in September, and we'll probably get multiple cuts by the time the year is out. So here is a little summary. Powell is dovish across the board from the same stage where he 2 years ago signaled the Fed would accept a recession, keep that word in mind, as the price of restoring inflation. So we had inflation up over 9% year over year in the middle of 2022. And the Fed said that they would accept recession as the price of lowering that inflation. But we haven't gotten a recession, at least not officially, but we will come back to that in just a moment. Here are some quotes from Powell. The cooling in labor market conditions is unmistakable. Okay, so unemployment is rising ever so slightly. We'll look at a chart of that in a second. It seems unlikely that the labor market will be a source of elevated inflationary pressures anytime soon. Okay, so inflation is coming down, and Powell doesn't think that unemployment is going to cause it to go back up. We do not seek or welcome further cooling in labor market conditions. Okay, well, nobody wants unemployment. But yeah, that's what he said. The time has come for policy to adjust. So instead of raising rates or even keeping them the same, we're going to be lowering rates. The direction of travel is clear, and the timing and pace of rate cuts, okay, rate cuts, he definitely said it, will depend on incoming data, the evolving outlook, and the balance of risks. Okay, that might be true. It also might be just a word salad. We'll see in just a second. And finally, we will do everything we can to support a strong labor market as we make further progress towards price stability. Price stability, this hilarious concept that the Fed claims to try to keep prices low, around 2% inflation per year, at least in terms of a long run average. To me, that is an absolute joke, but a lot of economists and investors take it seriously. So anyways, let's take a look. Let's look at the CPI. Let's look at unemployment. Let's look at the Fed funds rate, see how they're all connected, see if we're going to get a recession anytime soon, and see what you can do about it. So the CPI. This is what it looks like ever since the Federal Reserve has been keeping track, which is ever since the Federal Reserve has existed, going back to actually February of 1913. This was before the Fed by roughly a year. And you can see that the prices of things goes up like all the time. However, if you look at the CPI before the Federal Reserve, it actually went down on average for about 100 years, the exception being during wartime. But then during peacetime, prices would go down. So if you think about the first half of the Federal Reserve's dual mandate, price stability, you kind of have to wonder, why do we even have a Federal Reserve? If prices went down on average without the Federal Reserve, why do we need one? And ever since they've been in operation, prices have gone up on average. So something to keep in mind. We have over 100 years of history with and without the Fed, so pretty reasonable sample size. So what I want to do here is take this CPI and look at it as a percentage change from a year ago. Okay, so this is what we have here. The recent inflation, yes, was over 9% in June of 2022. So that's what Powell was talking about. You know, we had high inflation, and the Fed would have accepted a recession as the price of getting prices back down. And so now where we're at is 2.8, about 2.9% year over year. And the talk among the Fed and Jerome Powell is that inflation has come down, prices are reasonable, and compared to 9%, yeah, that's true. But compared to 0% or even falling prices, 3% increase year over year is high. And I don't know anybody who's happy with paying 3% higher prices today than they were a year ago. So if you ask me, if you ask the average consumer, if you ask the average investor, we think prices should be falling. But if you ask the Fed, they should be rising at roughly 2% a year. So they're happy with this. So the next thing I want to do is add to this the Fed funds rate. We want the CPI measured from a year before, and we want the Fed funds rate just nominally at each point in time. And you can see that these two lines are extremely similar. So you got to ask yourself, with the obvious correlation here, is one of them causing the other or not, right? Or is something else causing both of them? So let's ask ourselves this. Does the CPI, right, does inflation cause the Fed to react? Yes. I think that's obvious, right? They talk about it all the time. If inflation is high, they might raise rates. If inflation is low, they might cut rates. So of course, the Fed responds to the CPI number. Okay, does the CPI number respond to the Fed? Absolutely, right? When the Fed cuts rates, that's inflationary. That causes inflation. And when the Fed hikes rates, they do that to fight inflation and, thereby lower it over time. So the two things are very closely connected. They react to each other. And is there something that perhaps causes both of them to move? I would say yes, the existence of a fiat monetary system, right? They both go up and down because of the abundance of credit available and the fact that we use currency instead of money. So anyways, you can see here that during all the recessions, if you look at all the gray bars, something interesting happens. The red line, the Fed funds rate, goes down. It goes down here as well. Goes down here as well. Goes down here as well. You look at all these recessions and you get a dropping red line. The Fed cuts rates during a recession. And during the expansions, right, that even with COVID, and during the expansions where there is no gray bar, you see that the red line tends to go up. The Fed tends to hike rates. And you can see this throughout the whole chart. And even the times where rates were cut during an expansion, they weren't cut very much. Like right here, the Fed started at 9, almost 10%, and it went down to 8%, like barely got cut during that expansion. So if the Fed is talking about cutting rates now, I'm thinking, well, what happens when they cut rates in the past? That tends to be during a recession, right? And sometimes they cut just before the recession starts, a few months prior. And that seems to be pretty consistent. So if I'm looking at these recession indicators like the CPI and the Fed funds rate, I'm thinking, okay, it looks like we could be headed for a recession. Now let's take a look at unemployment. This here is the unemployment rate at any given month. And it's definitely cyclical. You can see a nice pattern here. And where we're at right now, unemployment's at 4.3%. And Powell mentioned that it is ticking up slightly, and he doesn't welcome, any more problems in the labor market. And I look at this curve and I see it rolling up, right? In the last 2 years, basically, it's rolling up. And I ask myself, well, what happens historically when the unemployment rate rolls up like this? And I see just before the COVID recession, it didn't quite roll up, it shot up. So maybe that's not a good example. But prior to that, we had it rolling up right into a recession, and then it shot up quickly, like in a straight line. Okay, so it rolled up into a recession, shot up quickly in a straight line. Prior to that, it rolled up into a recession, shot up like a straight line. Prior to that, it rolled up, shot up quickly into a recession. Okay, it's the same thing over and over. Every time it rolls up, we get a recession, and then it shoots up in a straight line. And there's pretty much no false positives on this whole chart. It rolls up and we get a recession. So I'm thinking we're getting a recession any day now. We might have just started one. Again, recessions aren't announced until several months after the fact or several quarters after the fact. So could be 6 months delayed at a minimum. So we could be in a recession right now, according to the labor market. And last thing I want to do on this chart is add the Fed funds rate again, just so you can see the two together, because it is interesting how inversely correlated they are, which means strongly correlated just in the other direction compared to the CPI. And you can see, again, if you look at any gray bar, any recession, the unemployment rate went up, which is what we just talked about, and the Fed funds rate went down, which is what we talked about on the previous chart. So you can see the blue line goes up, red line goes down in a recession. They move opposite directions here, and that's pretty true throughout the entire chart. So All the indicators so far are pointing to an imminent recession, or perhaps one that has already started, or if not, one coming very soon. Now, I want to talk about how the free market responds to the Fed funds rate. This here is the 10-year Treasury constant maturity minus the 2-year Treasury constant maturity. So basically, investors who are loaning their currency to the US government, typically, if it's going to be for a long time, they would expect a higher rate of return than they would for a lower period of time. So ordinarily, the 10-year rate would be higher than the 2-year rate. And when you subtract them, you'd have a positive number. That is why this chart is above zero most of the time. However, every now and then the yield curve inverts, and this difference here goes negative, and you can see what happens relative to the gray bars, relative to the recessions. When the yield curve inverts like this, we either get a recession right away or immediately following it. So when the yield curve uninverts like this, when it goes back positive, we're in a recession. Same thing happened here. So this is the double dip recession of the 1980s. We had an inverted yield curve, and then it uninverted, causing a recession. Then here, it inverted, and then it uninverted. And throughout this period of uninversion, we got a recession. Same thing over here, leading up to the 2000s. Inversion, uninversion, recession. Same thing. So this is yet another recession indicator. This is the free market saying, hey, when the yield curve inverts, we're expecting a recession to happen. And what's really interesting is right before the COVID recession, the yield curve actually inverted as well. This was in August of 2019. There were 3 days, very short inversion, but the yield curve did invert for 3 days in August of 2019, even before we knew about COVID. It's like the free market knew a recession was coming, even though it didn't know about a virus. And when the yield curve uninverted, we got a recession. I mean, this indicator is foolproof. And right now we have another yield curve inversion. It's the longest inversion in history. It's not the deepest, but it's the longest. And it's about to uninvert. Look at this. It's coming right back towards zero. And as it goes positive, look at this. This is what we're looking at right now. This is the exact same curve. I'll go back. It's the exact same data. Okay. And we're about to go past zero. And as we go past zero, as it uninverts, we would expect another recession. And this is the trend. Look at this. I just added these red lines here, going from the deepest part of the inversion to the uninversion. I mean, it's like clockwork. It happens over and over and over again. And so we look at all these recession indicators, the Fed's dual mandate, right? The CPI and unemployment. Those are both signaling recession. The Fed funds rate cutting itself is also signaling recession. That's usually what it tends to do. And the free market response in the yield curve is also signaling recession. So Jerome Powell didn't talk about recession. He said, "Oh, we don't welcome any further problems in the labor market, and we think inflation is under control." He didn't talk about a recession. He doesn't say it's coming, and maybe that's a sort of a political move. But it seems pretty clear to me from the data, from historical evidence, that a recession is likely on the horizon. So I want to conclude with an image of Jerome Powell in Jackson Hole saying, "Nothing to see here. Move along." So thank you all for watching. I'll see you in the next video.